Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash flowing properties in today's market. Here's your host, Gabe Peterson.
All right. Happy Tuesday, everybody. No, actually, I think this is a Wednesday. Happy Wednesday, everybody. I'm getting my days wrong. I hope you guys are having an absolutely fantastic day. This is going to be a good episode because we got Ruben Greth with us from Capital Raisers Show and LegacyAcquisitions.com. Ruben has a ton of experience from multifamily syndications to development to raising capital, you name it, he's done it. So we got a lot to cover today. Ruben, thank you very much for hopping on the show.
Sweet, Gabe. I'm really excited to be here.
Right on. I told you before we got on here, we like stories. So take us to the beginning of yours. How'd you get started in real estate?
Okay, cool. It started around 15 years ago. I started a meetup, was trying to figure out how to get my entrance into real estate. And I met this dude he showed up in Phoenix with a bankruptcy and was buying a bunch of fourplexes. So I followed him around to his projects, took videos of him, asked him, how he acquired them, how he's going to resident occupy them and get them back on the market and make a bunch of money real quick. This is back during 2009 and 10 during the fire sale. So we were essentially buying fourplexes for like $80,000. And through these videos that I was posting on YouTube and a variety of social platforms, we had some traction and people were reaching out to us, and we ended up raising about $600,000. And that was my entrance into capital raising and small multifamilies. I ended up splitting up with him, left real estate altogether, and then I'd say about 4 or 5 years ago, I wanted to get back into real estate. All I knew was fourplexes. So I started interviewing these syndicators and was asking questions like, hey, how do I build a team out? How do I get into this? And some of the responses were like, well, what do you care? And I was like, well, I used to raise capital. And I know that, big scale multifamily is great for scaling and for creating huge impact. And I'm curious. And they're like, wait, hold on. What'd you say? Did you say that you raised capital? We need somebody that can do that. Come on board with us. So I got an apprenticeship, raised about $1 million through Koji Peas, and then started a show about raising capital so that I could figure out how to raise money from limited partners, and then found out that there's this entire universe of capital raising. And that led me to go and become a fund manager. Once I found out about funds, I got pretty crazy about it. And we raised money for some multifamily syndicators and eventually dialed our business model to the build to rent subdivision space. So now we're building 475 houses and 3 subdivisions. And it's been a crazy, wild ride over the last few years, figuring out the capital raising side, figuring out the partnering side with other syndicators. And most recently, the development side is a whole can of worms that has exploded all over the place that I'm trying to digest. But it's been a lot of fun, man. That's kind of my story in a nutshell.
Nice, man. Yeah, I love it. It sounds like it's definitely been a roller coaster. You've been on a lot of different journeys, but they all sound like they're going in the same direction. There's so many ways we can take this right now. I was writing down questions as you were talking. The first, I don't want to spend all the time on capital raising because we've covered it pretty extensively on the podcast, but it sounds like you are an expert and you've done a lot of it. So I'd be remiss if I didn't ask what your top 3 tips for people who want to start raising capital for their own deals. What would you suggest they do to get started?
Yeah, what's kind of crazy is it depends on the situation, because if you're entering the space and somebody's brought you on board to raise capital like me, and you don't really know how to do it other than from JV partners, and now you're trying to raise from limited partners, there can be pressure from external, sources, people saying, hey, we brought you on to raise capital. Where's the capital? And you're like, well, I haven't really built a database or do anything, to go and acquire capital. Fortunately, I figured out a fast track, which was to go and find co-GPs and bring them on, give them a piece of your deal and a portion of your company, and then basically leverage their brand and their database of people. So I would say, like, if you're feeling a ton of pressure, like what you want to do immediately is like, I need to know everything about the deal, and that will paralyze you. So I'd say just go and make a bunch of friends, do a ton of networking, don't sell, and just tell people what it is that you're doing and leverage your team, right? Hopefully you've found some really good sponsors, some really good partners, and you basically rely and leverage their track record so that you can kind of say, hey, these are the guys that I'm representing. This is their track record. This is what they've done. And that will make life a lot easier versus, trying to know every single aspect of the deal. You kind of want to stay in your lane and just share what you know about the industry and why you like it, and let people self-select. So those are like kind of the main focus ideas that I would say, spend some time there.
Okay, I like that. So I'm just bringing this down to kind of the concrete level. If say I found, we do self-storage. Let's say I found a self-storage facility.
Yeah,
it was a killer deal.
self-storage.
It was like 300 units, and we really wanted it downtown New York. Let's just go big.
Okay.
And we want to take it down. But I don't have the capital. I don't know how to do capital raising. What would be the steps that I take from there?
So if you were doing that particular situation, you want to start building a presence online and educating and nurturing. So a ton of networking, a ton of social media, a lot of posting about what you're doing, and then generate conversations is where I would start.
Yep. Yeah. And this is why I say, if you have an inkling, if you have some kind of interest in podcasting, I always suggest people get, just follow that interest, because it is a great way to create an online presence. It's a great way to create kind of a brand around what you're doing. And it's super easy because you get to have awesome conversations with people like Ruben, and you get to get educated on all the topics that you don't know about. So, and another benefit obviously is capital. When you have this brand behind you, you can leverage it to raise capital for your deals.
Yeah, a interview-based thought leadership platform is what Joe Fairless goes into on the capital raising section of his book, The Best Ever Apartment Syndication Book. If you open it up, that's the first thing he says to do. And that's what he did to build like a multi-billion-dollar assets under management business.
There you go. All right. Next question that I had was literally, this might be a newbie question, but what does a fund manager actually do?
So they manage their own security is essentially what they do, which can be dangerous, especially if you're taking people and putting them into multiple securities, because you can kind of cross the threshold of looking like an investment advisor. And if you're not licensed for that, you can get into hot water. So you got to be very careful. But a fund manager manages their own database of people, their own investors, and their own security. And then a lot of times through a fund-to-fund model will select and vet sponsors and take money that they've raised and put the limited partners into multiple deals. So a lot of times syndication attorneys will say, hey, you want to raise for multiple deals, not one deal if you're raising funds, because the whole purpose of a fund is to mitigate your risk and diversify amongst multiple markets, multiple sponsors, multiple deals versus just one deal. But there's a lot of people out in the industry that are creating a fund just to raise for one deal, and that can be very dangerous too. So I'd be very careful and remiss if I didn't say go talk to a syndication attorney about that. But a security essentially is like a Coca-Cola stock, except you apply for a regulation or an exemption, better said, that allows you to raise capital without being regulated the same way a stock company would. So talk to your lawyer about that kind of stuff.
You always got to put the disclaimer there. I like it. All right, now let's talk about build to rent. That is something that is, development is something that's been on my mind, and build to rent is something that's super interesting. For a number of reasons. But first, how did you get into it? And then how do you, well, let's just start there because we can go into a number of questions. So how'd you get into build to rent?
Yeah. So some of the questions might be, like what market, why did you select it? We actually have a very easy answer to it. Our builders and our friends that do and are very good at that, they live in Lafayette. So they are investing in a great place because land is cheap. The cities are in pro growth. They want to provide housing for the citizens of Lafayette and those counties over there in Louisiana. So that's why we like it. But I got into it essentially because I have some friends that had built about 200 houses. And one dude was really good at building houses, and his best friend from high school had, I think, acquired or helped institutions acquire about $750 million worth of land. So he's very good at being a landscape architect and finding and acquiring those kind of pieces of land and working with cities. So between the two of those guys, they got together, built a syndication company, but had a problem raising capital. So they came to us and said, hey, take a look at this business model. Would you be interested in partnering with us? And since we're not builders ourselves, we stay in our lane as, equity providers. We let them do the building and the acquiring and the dealing with the city. And then we focus on marketing, managing either a fund or syndication, and then raising the equity and doing some property management and bringing some additional team members to the party. But we let them do what they are very good at, because I'm not the one that's going to be able to answer what brand of windows we put in or how thick the insulation is and stuff like that, right? So once again, we stay in our lane. We don't have to know everything. If somebody has questions about what's the brand of the tile that we use on the roof, I put them in contact with our builders.
So why did you choose the build to rent versus build to sell model?
Oh, dude, build to sell is struggling right now so there's a lockdown on house buying right now because all the people that have a great house are probably locked into like a 3% interest rate. So they don't want to sell. And then all the buyers, they're like, the interest rates are too insane. I can't get the same bang for my buck as I could 18 months ago. I'm going to wait for rates to come down. So like the buyers don't want to buy and the sellers don't want to sell. And yet a lot of people want to live in houses. So build to rent is a great solution for providing housing, not necessarily to help the economy buy houses. But if you want to live in a house with nobody above you, below you, to the left of you, to the right of you, like in an apartment complex with a tiny little patio that's your backyard, build to rent, or essentially if you're a resident, living in a house is a much better option, especially if it's similar in price point to an apartment. So that's some of the base reasons why we like build to rent. It's providing a opportunity for renters to get a home experience without actually owning a home. And then, of course, they end up staying a lot longer than apartment residents because they like having a backyard and a doggy door and whatnot.
That was actually going to be my next question, is why did you guys choose single family over something like multifamily? Because if you build 100 unit multifamily complex is a lot easier to build than 100 single family houses.
That's a great question. So we like to consider what we do, which is building subdivisions, as a form of multifamily, because it's one horizontal piece of land with a bunch of units with one property manager and one leasing agent. They're all in one place, and you manage them exactly like you would manage a multifamily apartment complex. So you build it, you rent it, you stabilize it, and then you sell the entire subdivision to an institution as one commercial real estate asset that is valuated the same way a multifamily is, in the sense that it's based off of the net operating income. So when you compare build to rent versus multifamily, even though they're almost the same kind of model, except they're, they got individual backyards and they're not attached, they're detached. We'd like a couple of things. If you're building a multifamily apartment complex, you can't rent any of it out until the entire thing is built, which means you have to give concessions away and then charge lower rents as you're getting people in. In the build to rent model, you're renting as you're building. So if you build 10 houses a month, you fill those, and then you build another 10, and then you fill those. And then by the time you're at like almost 100% built, you're already like 70, 80% occupied, which is perfect for refinancing, because in order to get agency debt to refinance, you have to be at 90% occupancy.
Interesting. So you guys, the model that you guys are operating under is it's build to rent, but you're with the intention of selling the entire portfolio once it's completed and stabilized.
Could you imagine if I built like a 200 housing subdivision and then had to go to escrow and sell each individual house?
Right.
That would be like brain damage.
That'd be a lot of fun.
That's like so many transactions. So yeah, we have the option to sell them either as single investments or, individual houses, or, package them in like groups of 10. But our intention and our business model revolves around the idea is like, let's build these, let's stabilize them, and let's sell the entire subdivision off to an institutional buyer that wants to have all of these brand new little assets all in one place with one property manager. Yep. So that's some of the things that we like.
Makes sense. So I know, your guys' lane is equity. You guys are raising capital. That's what you're good at. That's what you're focused on. I am curious, though, a little bit about the due diligence. I don't know how much you know about this, but when it comes to finding the land and deciding which piece, which parcel, which city, how did you guys define Lafayette specifically?
So once again, our partners live there. So we want to stay within a 4-hour radius of their zone of genius where they know the cities, they know how to select the land. We ourselves do not select the land. So just want to be clear, we stay in our lane. But our acquisition specialist, he knows which lands can be easily tweaked in terms of zoning changes, which ones are likely in areas that are not going to have crazy things come up in terms of studies. Like one thing that came up on a recent project is they did a core sample and then they found some bones in there. So then they had to go and do a survey, an archaeological study to see if there was an old cemetery there. And those kind of little things that are completely unexpected can throw kinks into your timeline. And now instead of starting the horizontal and building the streets, you got to wait for cities and people to do their studies to make sure that it's cool to build. But, those are kind of my base thoughts there.
Yeah, that makes sense. We were talking before we got on the podcast, sometimes we get land coming through our pipeline and we've thought about going through the entitlement process, but it's just like there's so much you need to know in terms of the many things that can pop up to kind of throw a wrench in the process. So we end up just wholesaling all that stuff.
Check this out. Build to rent is extremely different depending on where you're doing it, whether you're doing it in Portland or Phoenix or Atlanta or Dallas or the Southeast or Florida. Those are completely different business models, even if you're doing the exact same thing, right? Because land is much more expensive in other places. The appreciation that's happening in different markets is completely different from each other. So definitely, as you're getting into, if you want to get into build to rent, you want to partner with somebody who's very good at building. I think we mentioned this before the show. Instead of trying to learn how to build your houses by yourself or getting a mentor to teach you how to build houses, like go and partner with somebody that's already built houses. I would say the same thing for a fund manager. Instead of launching a fund and having a lot of investors say like, how many of these funds have you done? And the answer is 0. And then you have that objection. Like go partner with a fund manager, partner with somebody who's already done what you want to do. When you're scaling into multifamily or self-storage, partner with somebody who's already done self-storage versus like, I'm just going to go find a self-storage and take it down. That causes a lot of headaches, right? So that's the idea is you leverage the titans that have come before you and stand on their shoulders and ride their coattails.
Yep, exactly. I 100% agree, especially if you're new to any type of asset, partnering on a deal or even just investing in somebody else's deal to see how they run it is an awesome way to get that experience. I mean, if you really do want to be the GP on a development project, by all means, go for it. But I love the idea of partnering with somebody first, investing in somebody's deal, so you understand kind of how it works. It's a really easy way to kind of get a crash course, an educational crash course, before you actually, make mistakes yourself.
Yeah, especially in development, it's crazy the things that you have to learn, like everything from working with the city to the government. And then now you're talking about like everything from like grading the dirt to making sure that the sewers are connected or building your own sewer in some cases or sewage plant. and then all of the electric utilities and water, etc. It's just like it's a crazy ride trying to figure it out and teach it to people as you're kind of growing. So be careful with that.
Yeah, for sure. So it sounds like most of what you guys focus on is in the kind of the residential space, so single family, well, even multifamily. Do you guys do any other asset classes, or do you raise capital or purchase any other asset classes, or is it just those?
So I'll speak for myself. I love multiple asset classes. I like self-storage quite a bit. If I wasn't doing build to rent, I'd probably doing that. I think those are the two hottest commercial real estate syndication trends. That and possibly like medical office, triple net lease buildings, and short-term rentals are pretty hot right now. But those, markets can change and cities can say, hey, like you're not allowed to do Airbnb in the county lines anymore. So that's kind of a little bit scary, but we see build to rent right now as a very sexy model because there's such a huge shortage of houses all across the country and people can't afford to buy. So if they want to have a home experience, we're going to get residents that stay there for a long time. But we've raised capital for some multifamily partners, including like Matt Faircloth, Abel Pacheco down in San Antonio, and Emma Powell in Austin on a deal, and a couple others. Right now, we're definitely very, head over heels in love with the build to rent subdivision syndication space. But yeah, in the future, I think we'll probably either select new markets or include some different assets. Once again, I really love self-storage. I'd like to partner up with some self-storage guys and possibly some really good syndicators that I've met along the way that are in the multifamily value add space in certain markets.
Cool. I love it. All right. Well, with that, I am going to move us to the quick question round. Are you ready?
Let's roll.
Let's do it. Starts with books or any form of education. Give me 2 recommendations, one for general life wisdom and one for real estate or business.
So the book that comes to mind is one that I'm really in love with. A lot of people have heard of Napoleon Hill and his book Think and Grow Rich, but they may not know that he's written like 17 or 18 books. One of them is called How to Own Your Own Mind, which is definitely very powerful for setting yourself up for success as a business owner and in life in general. So I'd highly recommend checking that book out. It's not that similar to Think and Grow Rich. And then on the education side, the Family Office Club, I'm kind of biased because they're sponsors of my Capital Raiser show, but like find a, hopefully relatively inexpensive version of mentorship that's like in the 10 to 15,000 range. Cause there's a lot of guys that'll charge you like 50 grand. And they're probably worth it. But if you're like, hey, I need to get into syndication and I don't know if I have an extra 50 grand laying around to educate myself, like Jake and Gino, I'm going to their conference. I'm not associated to them, but I love that they have 1,000 people in the room and they teach multifamily. And it's a great place to find all levels of investors, everything from newbies to like full blown, very well known syndicators. So Jake and Gino on the education side, let's go with that. And then How to Own Your Own Mind by Napoleon Hill on the personal development side.
Nice. I actually have not heard of that book, the Napoleon Hill one. I feel like I've heard of all his books, but that's a new one for me.
Yeah, it came out in 2018.
Oh, really?
You know what's cool? It runs like a podcast where Napoleon Hill is the podcaster and he's interviewing Andrew Carnegie on like how he became successful. It totally sounds like you're reading a podcast as you're checking that book out. It's very powerful.
That's pretty cool. I'll have to check it out. And yeah, maybe I'll see you at the Multifamily Mastery 6 is what you're talking about. Right? Yeah. I might.
Shout out to Jake and Gino.
All right. Next question is for your younger self. So let's go back to the Ruben who had 0 experience in real estate. He was just getting started out. So go to him, look him in the eye, give him one piece of advice moving forward.
Yeah, like once you do your first couple of deals, it doesn't mean that you have arrived, right? So a lot of people think that like, oh, once they've gotten their first deal that like automatically things are going to be so much easier along the way. But I'd go back to him and say like, dude, stay humble and realize that the world and the universe is going to throw you a lot of twists and turns, and to be patient and stick with it and be resilient and continue to grind no matter what.
Yeah. That is so true. Doesn't matter how big, how many deals you get done, how much experience you have. There's always new things to learn, and so that's staying humble is a good piece of advice. All right, next question is for your business. The first three positions you hire form the foundation of your business. So, what were they for you, and would you do it differently if you did it again today?
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
That's a hard question. So virtual assistant, number one. Number two, a lot of syndicators don't contemplate. They're like, hey, I'm going to scale and become a GP. What they don't contemplate is like, hey, I'm going to have to manage employees. I'm going to have to manage co-GPs. I'm going to have to manage people under me. You've never managed people. It's kind of trippy. It's kind of hard. Like when you want to go and vacation and people are looking up to you, like, how do we raise capital? What do we do next? Like this thing's falling apart and you have to be there. You don't have the opportunity to just kind of, blaze out. I would say, a COO, somebody that helps align the vision of the team, that keeps everybody flowing in the same direction, is a really important hire. And then a marketing person that can help you scale, because capital raising is much more than you would think on the surface. You need some really good, strong social media presence. And if you're not willing or have the time to be on there every day, you need some help there.
Yep, for sure. So VA, COO, and some type of marketing assistant. Love it.
Yeah.
All right. Fourth question, one of the two. This one is about the U.S. It's a big place, a lot of opportunity out there. Give me the single metro, and I'm going to take Lafayette out of the mix, so you can't choose Lafayette.
Yeah.
Give me a non-Lafayette metro in the U.S. that you're most excited about investing in today.
Today, I would say it'd be very tight between Dallas and Phoenix, but because Phoenix has a greater appreciation, but Dallas has a lot more syndicators that live in town that are experts at what they do. I'd probably go with Dallas.
There you go. Yeah, Dallas is one of my favorite metros too. In fact, we're doing like 2 deals out there right now. I really like that area.
Here's what I heard about Dallas is that like in 2100, it's going to be the biggest city in the country, bigger than New York and Chicago and Los Angeles. I don't know if that's true, but I can imagine based off of the growth and like all the new. Oh, no, not that it's going to be the biggest. It's going to be the highest earning income city in the United States, which is crazy when you compare it to some of the other cities.
Yeah, that is interesting. I would believe the highest population because all they got is land out there. They can keep growing as much as they want. All right, next question is about finding deals. So we will talk about how are we going to phrase this for you. You do capital. So let's say answer this two ways. What is your favorite way to find new GPs, and what's your favorite way to find limited partners?
So you could use the same answer for both, which is podcasting. So when you're interviewing a bunch of syndicators, I ask them like spiritual questions, like to see if they're spiritual or not. A lot of times it catches them off guard, but based off of how they answer that, it's already telling me like if I want to do business with them. But then you want to look at their track record, and their communication infrastructure is a huge thing because they can be great at finding and acquiring and getting returns on deals. But if they're not answering the phone or communicating or have a good communication infrastructure in place, it's going to make for a very poor experience and a loss of retention in terms of investors. So I would say that, but kind of changed my answer. Podcasting is great, but omnipresence in social media platforms, meetups, networking, conferences, being on stage, all of those things are multiple touch points that people, if you have a great lead magnet, like a written book or something like that, all of those are great for having your name out in the market in different places and giving limited partners touch points so that they can see that you're in a lot of places that are not going anywhere.
Nice. I like it. And that's interesting that you said you asked spiritual questions. Give me an example of something like that you asked.
So one of my favorite questions is, have you ever experienced a miracle or experienced a life-threatening situation or a near-death experience is the way I phrase it. So some people are just like, no, I've never experienced a miracle and I've never had a near-death experience. And really what the answer that I'm looking for is life itself is a miracle, right? Like the fact that we are floating around on a little blue bubble and mostly empty space, experiencing consciousness is like a 1 in a billion chance, if not, like crazier odds. But the way that you approach life, and if you're grateful and you feel like you're in a state of awe, I think is a very powerful answer that I'm constantly looking for from speakers versus like, nah, look, I'm not spiritual. I don't care what spiritual, religious background you have, but I do believe you have to rely on a higher power than yourself.
Yeah. I think it was Einstein that said either everything is amazing or nothing is amazing.
Yeah,
And,
I think
I really
the way
like
that he phrased it is like one of the most important questions you could ever ask. This is Albert Einstein, is whether you see the universe as a friendly or hostile place.
Yeah, and it's all comes down to your perspective. Love that. All right, I'm going to move us on, though, to the next question. And this is about mentors. We've already talked about the importance of mentors. So let's talk about your life. None of us are islands. We all stand on the shoulders of giants. So who is one mentor who has contributed significantly to your career today?
Let's go back to my very first fourplex multifamily partner. Even though like we split up, like he got me in the game. So I got to give him props for, talking to me and my audience about simple concepts that like are right from the Rich Dad Poor Dad book. Like, don't buy a car unless you buy an asset that can pay for your car. Right. So just very easy, simple concepts that people can resonate with. Like, don't buy liabilities, buy assets that can pay for your liabilities. He was a great mentor that I still kind of look up to and am very grateful for the fact that he taught me the game of multifamily and capital raising. Well, he didn't teach me the capital raising side, but definitely the multifamily and acquisition side of things.
Nice. Yeah, I mean,
his name is Ivan Navarrete. I should have mentioned his name.
Ivan, and I'm not going to try to repeat that last name because I think I'd butcher it. But thank you for Ivan for helping Ruben get to where he is today. And yeah, even if people don't stay in your life the entire time, if they help you even one step forward, it's something to be grateful for. So love to hear that. That leads us to the last question. This is for the listeners. I'm sure people want to reach out, get in contact with you, learn about what you're raising capital for, maybe learn how to raise capital. What is the best way for them to reach out and get in contact with you?
Yeah, if they just want to hang out and network, LinkedIn is a great option. If they are interested on the capital raising side, tune into the show, capitalraisershow.com. And if they're interested in build to rent or co-GP opportunities in that development space, they can find us at legacyacquisitions.com.
Cool. I will put all those links in the show notes. So if you all want to reach out, just go ahead and click the little more in the description. It'll pull down that full description, and in there you can find those links. All right, Ruben, that wraps it up. Thank you very much for hopping on the show.
Thank you, man. This has been a lot of fun.
Absolutely. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe, therealestateinvestingclub.com. And if you guys want to support the show, all we ask is a like, subscribe, share, all that jazz. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.